The module that we are going to cover is going to explain the maths that goes into housing finance and some concepts that go into housing finance in the mathematics that we are going to talk about. So let's start by understanding what is LTV, the loan to value ratio. It is the ratio between the loan that you take and the value of the property that you buy. So for example, if you buy a house worth say 50 lakh rupees and you take a loan of 30 lakhs, then the math says that the loan to value ratio is 60%, which is 30 lakhs divided by 50 lakhs. Now, from a lender's perspective, the higher the loan to value ratio actually means that there is a risk in case the property value falls. Continuing with our example, if you had taken a loan of 30 lakhs on a property worth 50 and the loan to value ratio therefore was 60%, but if the property prices fell by say 10 lakhs to 40, then suddenly the loan to value ratio has gone up from 60% to 75%. An extreme case, of course, it could become negative, in which case a portion of the loan is unsecured. However, in reality and in practice, most lenders and banks, subject to your repayment capacity, will certainly look at trying to give you as much as they can. There is a regulatory requirement also. The regulator has specified that you cannot give beyond a certain percentage of the value of the property for the reasons that I just explained. What if the property prices fall? These are different limits prescribed by the regulator from time to time, and it's something that you as a lender should be aware of as you write your credit policy and apply this policy to the loan that you are going to give. The regulator, as far as banks, housing finance companies are concerned, primarily is the Reserve Bank of India, the RBI. The National Housing Bank is the regulator for the housing finance companies that are established. And there are approximately 90 such housing finance companies in India as we speak. Increasingly, in the last 24 months, the Reserve Bank of India has been taking over the regulations to be able to provide an even playing field between the banks and the housing finance companies. As a lender, you need to be cognizant of the loan to value ratio because that impacts the value of your security. For example, the property prices, if they fall, then without any action from either your side or the borrower, the loan to value ratio starts increasing and creeps upwards to almost 100%, which then potentially makes your loan partly unsecured. As a borrower, you must borrow the maximum that you can service. And the important thing to remember here is the maximum that you can service. Even if you are getting a loan which is much higher, you should be sure that you will be able to pay the loan. Because the idea of taking the loan and buying the house is to be able to repay it and live in that house for many, many years. And therefore, borrow as much as you need to, borrow as much as you can service, and borrow as much as that does not cause stress to your monthly cash flows. Now, the next ratio that I want to talk about is what is called the installment to income ratio, otherwise in brief called the IIR. Please don't mix that up with the IRR, which is the internal rate of return that we calculate on a project or a financials. This ratio is the mathematical calculation of how much you can actually pay, the installment that you have on your loan, which you propose to take, divided by the income that you and your family have earned or are earning. Again, from a lender's perspective, it is important to keep an eye on this figure because after all, a person is going to service the loan from the disposable income after meeting his day-to-day typical expenses. Think of it in real terms now as a borrower. If you were earning, say for example, 100 rupees and you have certain expenses day-to-day to meet, be it schooling of your children, be it rent, be it food, be it medical, and be it education expenses, etc., you will only have a certain amount left, disposable income as they call it, to service a loan which you might take. That percentage again depends on the credit policy of a company. Traditionally and historically, people have taken 30 to 40% as a good ratio to have to be able to service the loan. But Again, depending on the product, depending on the customer and the profile of the customer, your credit policy might actually specify either a higher percentage or a lower percentage. The installment income ratio is probably one of the most important ratios when it comes to calculating loan eligibility. Put yourself in the place of the customer. If you were earning 100 rupees, how much would you pay? Maybe you're married, maybe you're about to get married, maybe you have certain specific expenses, and then you calculate how much is available to service a loan. I now want to come to the third ratio, and that is called the fixed obligation income ratio, otherwise called FOIR, or in more common parlance, FOIR. Now, what is the difference between the fixed obligation income ratio and the installment to income ratio? The difference is that the FOIR or the FOIR additionally takes into consideration any other loan installment you might be paying. The monthly installment that you will pay for the housing loan plus the loan that you might be servicing, the monthly installment on that divided by your total income becomes your FOIR. So for example, you might have a car loan. For example, you might have taken a loan for your education. For example, you might have taken a loan to buy some white good, and that installment you are also servicing from your income. If you are doing that, then it impacts your ability to service the loan. So just to complete that example, if you have taken no loans, then your installment income ratio, which is the IIR, and the fixed obligation income ratio, which is the FOIR, are the same. In case there is a loan that you have taken, then the FOIR will always be more, taking into consideration the loan servicing you're doing outside the home loan that you are taking.